Good afternoon, everyone. Today on the final bar, we have my guest, Will Geisdorf from Ned Davis Research, a good friend and a fantastic technical analyst giving his take on stocks and bonds. We're also going to learn a little bit about volume, how to think about that. We have a mystery chart, which I think is going to be very compelling, something we'll talk through. We'll finish up with the 3 and 3. Ladies and gentlemen, this is the final bar. Hello, everyone. Good afternoon. Welcome to the final bar. This is Dave Keller, Chief Market Strategist at StockCharts.com. Just returned a few hours ago from Minneapolis, Minnesota. My producer, Gretchen, and I were on location in Minneapolis, speaking to the CMT Minneapolis chapter, also sitting down with Craig Johnson from Piper Jaffray, Jeff Hughes from JWH Investment Partners, and then we spent a fantastic day with Ralph Acampora with the world's largest chart of the Dow Jones Industrial Average. So we captured some really cool thoughts, content, ideas, routines, and guidance from some really sharp, capable, experienced analysts. And we look forward to sharing with you some of their stories and some of their pointers over the coming weeks. So look forward to sharing some of that with you, including Craig Johnson will be our guest tomorrow. We'll share a part of our conversation with him. You know, the market overall pulled back a little bit, sort of sideways. Before we get to the market recap, though, I do want to point out to everyone, I will be appearing at the Traders Expo in Las Vegas. Those of you that are in the Las Vegas area, I look forward to seeing you there. It's November 7th through 9th. If you're not in Las Vegas, they have a live streaming option that you can sign up for. I'll be speaking Friday evening, the 5 modes of mindful investors, talking about mindfulness, how to think about behavioral biases, get your emotions out of your way, and embrace the way you can look at the markets through an emotional lens. So look forward to seeing you there. For information, go to stockcharts.lasvegastradersexpo.com. I want to get into the market recap. It's been obviously another interesting day. We've got a heavy earnings week, and so there's lots of movements. The big jump on Netflix, going into the open today was something I certainly was looking at. We're going to take a look in a moment about what happened during the trading day. A little different than maybe what some may have expected. You know, same thing that has happened a number of times. The day starts with a certain characteristic, and then by the close, we've sort of come off a little bit. Looking at the last 5 days of trading, you can see how, here's the last hour, and again, sort of weaker over stronger. But in the end, this is the sort of trading day that I think Fibonacci retracements were sort of designed for. Common practice is sort of take that opening sort of range or take that initial move in the morning and then watch how the afternoon plays with those extremes. So we're not going to do it here, but that's, anytime we have a significant move in the morning session, it's sort of good to put the high and the low and look at how we trade around that framework. So overall, we've held up fairly well over the last couple of days, but directionally, since that initial move on Tuesday morning out of the open, we've sort of been sideways. That's sort of how the market has felt. Looking at the daily chart again, the last 2 weeks have certainly been stronger coming out of the lows the first couple of days in October. Again, we're sort of approaching this congestion area, or what I tend to call a supply area, an area at which buyers have been exhausted or sellers have come in, but for whatever reason, there's profit taking, there's new shorts, there's whatever it is, but the market has tended to find support. So there's a real significant resistance area that we're in here and are now sort of engaged in. So the question is there enough juice in the earnings that come out to sort of propel the market higher, or is this the point where we would stall sort of in that resistance range where we would normally expect it? That remains to be seen. Looking at sort of the market indexes and how things played out, the NASDAQ up just over 0.5%, the S&P up 0.25% by the close. The Dow Industrials just above flat for the day. A couple noteworthy points on here. Number one, small caps leading the way. So this is a little different than a lot of the looks we've had over the last couple of weeks, right? We've had where the largest names, the mega cap names, the S&P 100 sort of leading with small caps and mid caps at the bottom. It's sort of reversed here with, sort of the traditional pattern you would expect in a bullish phase where you have the smallest, most speculative companies leading the way up. We had a great conversation with Jeff Huge. We played his conversation on Tuesday on the show. If you missed that, go to the YouTube channel. You can see it. We talked in particular about transports and how he saw that being a really key indicator for the markets going forward if it was able to push to new highs. And that's obviously airlines, railroads, a lot of things in transport. So interesting to see it up a little bit more than the S&P today. On a sector basis, healthcare and real estate, the two strongest places, followed by communication services. So some really interesting charts in healthcare. Some number of earnings releases this week was certainly causing some upside there. With real estate, again, one of the most conservative parts of the market, consistently appearing at the top of the list. What appears at the bottom, things like financials, things like technology. So, again, just so far, we've had this mix of evidence where, in some places we have sort of the, sort of traditional offense doing very well. Other places, the traditional offense doing a little weaker. So no real clear signal, I would say, overall from this. It's sort of an indecision, which is, again, how the charts have played out, sort of a sideways move, that third most frustrating move. The number one industry group out of the indexes, the ETFs here that we're following, are hospitals. That's why the healthcare sector was up so much. Oil services down, and then followed by insurance. Semiconductors, again, we often think of as sort of a leading indicator for the stock market. Tends to do well in bullish phases. Notably was flat for the day. Really didn't participate in the up move. The chart of India is actually a really interesting. I want to go just very briefly through some of the individual names here and on individual charts. The India ETF approaching this really key resistance level. I tweeted this out earlier. I'm just looking at 34. It's had this nice gap up this morning, sort of closed above the open, closed above the 200-day, but we're really at this key resistance level of 34. If you'd see this ETF eclipse that and have that follow through the upside, really clears the way to the previous highs around 35.50 to 36. So it's at a really interesting point. That's definitely a chart to pay attention to if you've not so far. I want to go through very quickly through just a couple other charts here, looking at the market dashboard, or my dashboard. And again, if you're not using this, you're missing out on probably one of the more helpful parts of the StockCharts platform. I did want to bring up Netflix. This is one of the many names that earnings this week. It's a heavy earnings week with a lot of sectors represented, a lot of different groups and themes. This is what the Netflix chart looked like, and it's interesting. It's how you interpret the earnings call is how I guess I would summarize it. But people vote with their feet, and so there's an initial excitement out of the open, huge gap above this previous resistance level. But look at what happened: clear distribution through the day, and by the end, we're trading almost back down to the previous day's range. So short term sort of a jump, but does that have staying power? And I think the chart would suggest not so much, right? When that's the reaction you have to earnings, it's usually a little more negative than positive. IBM, another earnings number that the earnings release that disappointed. You can see the stock gapping down from 142.50 to 135, just like that, and now sort of at the lower end of the range there. There were some really compelling positive stories, things that are breaking out to new highs. This is CCI Crown Castle. This is one of the REITs. This is why the real estate index looks so positive. Breaking above this trendline resistance, if you connect the highs from September and October, sort of an upside follow through, a nice move and a nice close toward the highs, potentially trying to reclaim the 50-day. So some interesting movements on there. And again, the dashboard, as I showed you, is one great way to just capture which stocks are moving, and then things like earnings and other things that are causing it. That's how you can start to fill in the picture later once you see the movement in the chart. I want to transition now to the mystery chart. We haven't done this in a little while, I don't think, but it's one of the popular sessions that we do, popular segments. So my question to all of you is, what is this chart? I'm not going to tell you anything more besides it's a security that trades in the U.S. It's something we have certainly talked about on the show multiple times in the first couple weeks of existence. This is the price, a daily chart on the top, and then the RSI on the bottom. So if you have a guess, go into the chat room, which is just on the right side of your of the TV window. Put in a guess, a ticker, whatever it is. Our producer Gretchen will take a look at that, and later in the show we'll reveal what this chart is and why it's an important one to pay attention to. And again, I would guess many of you have looked at this chart at some point in the last couple weeks, but we'll see how well you can pick it out. So the question is, what is the mystery chart? Put your guess in the chat room, and we'll reveal it a little later in the show. Now I want to transition to talking technically. Again, one of the great features of StockCharts.com is education. It's one of the three pillars: information, education, and commentary. And so education is really important. We want you to understand how to use charts, how to use the StockCharts system. So my colleague, Mary Ellen McGonigal, sat down with us a little recently talking about volume and how she uses it in her process. Let's hear from Mary Ellen McGonigal on volume.
Today we're going to be viewing the power of paying attention to the volume that a stock displays on any given day. And the reality is, when examining stocks that are acting in a particular fashion, if they do so on volume, it's very, very telling. In fact, it's telling you that institutions are in there either supporting the stock or selling it. And oftentimes it's not going to be a one-day event. These institutions, it takes them many days to build a position and likewise to dispose of a position. So you will want to pay attention to above average volume in your stock on any given day. We're looking at PayPal here. This is a daily price chart. And what I'd like to draw your eye to is down on the bottom. Quite simply, you can eyeball the volume. However, there are many alerts with StockCharts.com that will identify stocks that are either up or down on high activity or high volume. So let's take a look at PayPal, and we can see I'm taking you to a mid-March point in time. Really, you can see over this average 2-week period, we're taking a look at these two high volume days and see what they can tell us about this particular stock. This first high volume day is going to be upon the stock breaking back above its key 10-day simple moving average. Now it's up above resistance, it's freer to advance, and we can see that sure enough, the stock does advance beyond that, given that high volume. The next high volume day is 2 days later, as the stock emerges from what we call a base. And as the stock breaks out of a base, if it does so on volume, that is very powerful. That's confirming to you that the upside potential for this stock is in fact there. And we can see from this breakout on volume, the stock advanced quite significantly.
So that was my colleague, Mary Ellen McGonigal, talking about volume, how to think about it. And again, if you've watched my show over the last couple of weeks or heard me on Stock Charts TV before, you know, volume is not one of my primary tools. I sort of bucket volume and a lot of other indicators on the checklist as something called confirmation. So it's an important part of the process. For me, it sort of comes at the end, right? Price is key. You start with price. You want to make a conclusion based on pattern, based on breakouts, support and resistance. But then you always want to look at the volume picture and see if it supports or disagrees with what you're seeing on the price. And when you see confirmation or non-confirmation, that's when you really start to get some interesting data points. And for me, putting the volume on the chart can be really helpful, indication of interest on one side or the other. You can overlay volume on your charts at the bottom. Also, on-balance volume is something that I've used out of all the volume reads that I've followed. That's probably the most important one to me because it shows you, is there confirmation? Is there support over time, not just on a daily basis, but over time for what you're seeing in price. So volume and the different ways you can incorporate volume, something to look at if you've not incorporated them in your charts so far on StockCharts.com. We're going to take a brief commercial break. We're going to come back with my guest, Will Geisdorf from Ned Davis Research. Talk to you in a minute.
The Chart Watchers newsletter features expert technical commentary about the current market from some of the industry's leading technical analysts. See what's really happening in the markets through their eyes and gain an edge in your own investing. The newsletter is packed full of insightful and educational articles intended to help you become a better investor. Whether you are brand new to charting or a seasoned technical analyst, each edition will provide a wealth of informative content. It's the best way to stay informed on all the latest news, events, updates, and additions here at StockCharts.com. Whether it's a new feature or blog, an upcoming conference, or a special sale, you'll hear it first in the Chart Watchers newsletter.
Hello, everyone. Welcome back to the Final Bar. This is Dave Keller, strategist at StockCharts.com. I want to welcome on my guest, Will Geisdorf from Ned Davis Research. Will, thanks so much for coming on the show. Good to have you on.
Oh, thanks for having me, Dave.
And I have to tell you, on a day like today, this is the beginning of what they call, I think, the big dark or something like that, where Seattle becomes a little more overcast, a little more rainy. I think of you in Florida, and I always did this in Boston. We had a heavy snowstorm. I think of what Will was doing at this moment. I always had pictures of you golfing, doing something fun. So tell me you're doing something like that at some point in the week, all right?
Yeah, no, definitely will.
So you sent a chart ahead of time. Thanks so much for doing that. Looking at stocks versus bonds. Can you talk through what you sent and what it means to you?
Yeah, so this is a chart that we featured in a publication this week where we've just been really seeing for the entire year that the stock bond ratio has been consolidating. We haven't seen a clear uptrend or downtrend. And one of the ways I tried to kind of put some context around it was to just look at the stock bond ratio, which is the blue line in the chart, and its relationship to its 1-year average. And I just put some barriers saying, well, how long is it traded within 5% of its 1-year average? And the bottom part of the chart almost looks like shark's teeth. That's basically just telling you how many weeks in a row that the stock bond ratio has been within 5% of its 1-year average. And it really stands out. As of last week, we're at 39 consecutive weeks. So basically the entire year, we've been glued to the 1-year average. And we haven't seen this type of consolidation since the early 90s. And so we've been experiencing it. And I mean, we're trend followers at Ned Davis, and you get whipsawed somewhat when you have these types of tight consolidations. And so one was kind of putting some context around it, and then kind of looking at what are the catalysts that are going to get us eventually to break out of this consolidation.
It's interesting, and I love seeing a chart that sort of summarizes how the market feels, right? It feels like this. It feels like there's this sort of balance or sort of this indecision, and the question is just which way we move. From a technical perspective, is there anything you're seeing that would give any sort of color on which way you see this breaking, or is it more of a macro call at this point?
Well, I mean, from a technical standpoint, usually these types of consolidations are resolved in the direction of what was the previous trend. And if you look at this chart, we were in a clear uptrend since 2009. So just from a pure technical standpoint, I would expect that we get eventually a resolution to the upside. I mean, our belief is that stocks versus bonds, we're in a secular bull market right now. And then just from a macro standpoint, I think really what would cause a breakdown would be a U.S. recession, and that's just not our macro team's base case. So the technicals and my kind of macro read both point to an eventual upside breakout.
Very interesting. And I love, I've followed, Ned Davis and your work obviously for years, enjoyed reading it in my Fidelity time. And I always loved how you combined the technical with other disciplines, right? It was sort of part of the puzzle. It wasn't the entire puzzle, it was part of it. So when you're talking to clients or when you're providing your content, how do you sort of point them, or how do you encourage them to use the charts in relationship to other things? Where should it fit into someone's process, do you think?
Yeah, well, I mean, a lot of our clients, our big institutional clients, are more kind of a macro fundamental discipline, or they come from that. And we always say, the macro and fundamentals tell us what the market should be doing, and the technicals tell you if it is doing that. And so a lot of our clients, I mean, for me, it's if they have a strong view one way or the other as to stocks versus bonds, this kind of provides a little bit of reality. And so, we've gone nowhere this year. And so the technicals are a bit of a check to someone's strongly held fundamental and macro views. So that's where the technicals really can provide some discipline.
That's great. One of my former analysts used to say the charts are the truth serum for the markets. They tell you what's actually happening. You can't second guess it. So going back, if we could, just to wrap up, so it seems certainly more constructive, stocks over bonds. That all else being equal, looks like the potential future path according to your work. What would maybe tell you you're wrong, or what would you see that might tell you that that's not the right call? Would it be something, some sort of breakdown on this particular ratio, or would it be more an individual look at stocks or bonds separately? What would it be?
I would say if we start to see the macro backdrop in the U.S. Weaken substantially, that would be right now we see little threat of a recession this year. So it would have to be. I mean, we have a number of indicators we're watching for kind of key level recessionary levels. We'd have to see a few more of those indicators check the recessionary box for me to think that we're going to that my expectations for a breakout to the upside are incorrect.
Perfect. That's a fantastic chart. A really good take on the markets. Will Geisdorf, thanks so much for joining us today. Really appreciate it.
Thanks for having me, Dave.
Folks, that was Will Geisdorf from Ned Davis Research. They do some fantastic work on long-term market history and always, as we mentioned, thinking of charts as the truth serum for the market, showing you what's actually happened. And as we've talked on the show, right, I think the value of charts is that the reasons why charts play out a certain way usually makes a lot of sense in the rearview mirror, but looking forward, it's a lot of speculation, right? In the end, the charts are what you can't restate, or as Ralph Eckenpour would just spent the day with yesterday, you can't restate price. Price happened. Next, did you know what the mystery chart was? Do we have any guesses? And here we go. Disney, okay. Apple, unfortunately, or actually fortunately for Apple, it's in a much better position, popped up pretty well in the TLT. All right, 3 actually pretty good guesses. Thanks everyone so much. Some of you were absolutely right. That is in fact the TLT, the Treasury Bond ETF. So an interesting chart, sort of paralleling what Will was showing, again, with the stock bond ratio and thinking of this rotation from stocks to bonds, clearly has been favoring stocks for a little while and thinking of what that might mean. But here we're looking at the TLT, and again, I've sort of illustrated. I sort of put some of my own analysis on here with the green lines illustrating the symmetrical triangle, what we'd call a coil, which is a pattern of lower highs and higher lows, a consolidation period. So as you can see, we have the 200-day or the 40-week moving average sort of flattening out. You have this consolidation since the rally in August, and then over the last 6 weeks, 7 weeks, it's essentially been coming together in this consolidation pattern, now testing the lower end of that range. So what's interesting to me, and again, why I asked Will about, sort of what he saw and what might tell him he's incorrect from a technical perspective, we're at this point where, a breakdown here of the TLT would sort of be a reversal. This is traditionally a continuation pattern. Traditionally would mean we'd resolve this to the upside, but what's happened in the last couple weeks, 6 to 10 days, is we've had this reversal. We're now at the lower end of that range. So I'd be very interested to see, and I'll be certainly watching which way we break here, because the cool thing about a consolidation pattern is it has to break one way or the other. There's a natural end to this consolidation, what you call the apex, which is over here on the right side of my screen. So at some point, you either have to break below support or break above resistance. And more often than not, the direction of the breakout, the momentum, is sort of people pushing the market out of that equilibrium. You have a disequilibrium as buyers or sellers take control and push it out of the way. Now, again, as the conversation with Will sort of highlighted, there are many, many macro reasons why this should or could break one way or the other. And again, I don't think that's necessarily the purpose of our conversation here. It's more to illustrate that you have the consolidation, you have the sideways trend, and now it's all about which way we break. So this chart in particular is one I'd encourage you to pay attention to. There are a lot of different ways, obviously, to break down the fixed income markets and just get a sense of what bonds are doing. Besides the TLT, there are a number of ETFs like the AG and others. Also, we can look at just the 10-year Treasury yield, for example, and look at support and resistance levels there. In terms of fixed income instruments and looking at charts for it, one of the questions we received recently was, does it make sense to use charts on something like bonds because they're so manipulated, right? There's all these reasons why that the curve is going to flatten or steepen, and that interest rates are going to go up or down. There's the Fed and all these other macroeconomic inputs that are going to cause this. And I would say, yes, I think especially with ETFs, it's a really good way to just make sense of where the trend is. And if you think like a trend follower, going back to Will's charts, look at the long-term trend and see what's happened. Even though day to day, over time, there can be obviously a lot of reasons why interest rates are going to fluctuate, why bond ETFs are going to go up or go down. Looking at that overall trend, looking at the fluctuations from a technical perspective, it can be one of the inputs as you think about the overall interest rate environment. And then again, the implications for interest rates, the implications for banks, the implications for the broad equity universe. So I would pair this mystery chart along with the chart of the XLF, which is the sector ETF. And just give me a second to bring that one up here. We've talked about the XLF a number of times. This is actually one of the, maybe the last mystery chart we looked at, if I remember right. But again, if you pair that chart of the TLT, with the chart of banks, we have a lot of financial firms that are reporting this week: Citigroup, JP Morgan, Morgan Stanley, all of these. And so, the XLF, the financial sector, obviously very much weighted toward those big banks, testing a huge resistance level. So you have this situation with bond prices consolidating, financial companies, financial stocks, testing key resistance. So you could make an argument that, that resistance is just too much for it to handle. It could roll over here. But if and when the XLF would eclipse this resistance, break above 2850 a little further, that would certainly be a huge change from a monster base that's taken 2 years for the XLF to play out. So I would pair the two of those together, the TLT, the bond ETF, and the XLF, seeing how banks play out today and what that means. We're going to finish off today's show talking about the 3 in 3. As you know from watching the show, hopefully many, many moons before today, we like to finish with 3 charts in 3 minutes. And the idea here is to highlight 3 charts that if they are not on your radar, they certainly should be. I'm super excited because today I actually gave myself 3 minutes. I usually cut it much closer than that, so we're doing well. The first chart is the S&P 600, the small cap index. So it's $SML. And I highlighted this because, if you, over time, we've talked about this theme of small caps, mid caps underperforming, and micro caps probably the worst performer over the long term, right? You have the situation where the largest S&P 100 mega cap type of companies have been the leadership. Small caps have lagged behind in the most recent up move. That's actually changed a little bit. And if you look at it just from October 8th, which was, we had that initial rally, out of the October low at the beginning of the first week of the month, sort of the largest companies kind of jumped very quickly. But after the secondary low on October 8th, actually small caps have performed very well. They've been the best performer out of that group. So it actually has rotated a little bit over the last couple of weeks, where small caps have actually done very well. If that is the beginning of an emerging theme, and if you start to see small caps stronger and stronger, that would certainly be a different environment than we've seen. May suggest that you go lower in the cap tier, look for, screening ideas, lower with smaller companies, look for opportunities there. So another way you can see that is on the relative performance here at the bottom. We can see that small caps underperformed for the 4 weeks leading into that October 8th low, and then look at how the relative strength has turned higher. So if that would continue and we see a continuation and move to new relative highs there for the last couple months, that would certainly be a different environment. Again, would lead me to look for ideas down in the smaller companies that you might have sort of mentally pushed away. The second chart is a chart of EFA. This is the MSCI EFA ETF, tickers EFA. I like to look at the spiders, the EFA, and the EEM, which is the emerging markets ETF, all 3 of those together, just to get a read on global markets versus U.S. Last week or earlier this week, we looked at a chart of the U.S. versus the world. It's something we've looked at in a number of different ways over time. Here we're actually looking at EFA in particular. You can see that EFA was actually up very strongly, gapped up in the morning today, closed a little lower, similar to the S&P. So a little bit of distribution as the day went on, but you can see it's back in this resistance range. So at EFA, similar to the S&P, sort of testing that supply area, the area at which the gas, we've run out of gas before. So a little distribution right at resistance doesn't usually make me feel good for the next couple of days, but it's worth noting that over the last 2 months, EFA has actually outperformed the US, not by much, 2% over the last 2 months, but boy, that's something. That's a different pattern than we've seen. So again, if that continues, that's a trend I'd certainly want to follow. And that would probably only happen if EFA breaks 2 highs. And that would take me to our third chart, excuse me, which is the US dollar index, $USD. Now this is end of day, so it's not quite updated for the close yet, but if you look at the UUP, you can see we closed down pretty strong on the dollar. So I've highlighted this corrective move in the beginning of this year after the December low, very similar pullback in June, and now we're about 2/3 of the way through a very similar pullback here. So I sort of lined up, what if we had the same type of pullback, which are similar to sort of these bull market corrections we've had in the dollar index? That would take us just below the 200-day moving average, around 96.75 for the dollar index. So again, if this is similar, if we see the RSI bottom around 40, similar pullback to previous cycles, we're sort of getting near the end. But again, if we break through support, break through the 200-day, boy, that would be a different environment as well. So 3 and 3 charts I'd encourage you to pay attention to if you haven't so far. That's the final bar for today, Thursday, October 17th. Email us any questions you have, any feedback on the show. Really appreciate your thoughts and questions. The final bar at StockCharts.com. We follow that very closely. Also on Twitter at FinalBarSCTV. Want to remind you to check out our YouTube channel, StockCharts TV, for all the old shows. For the final bar, this is Dave Keller.